Tax is one of the things that I think, one of the things that we spend the most money on that we don't pay attention enough.
Of course, that's always what we want to avoid where possible.
Create more opportunities, create more value in the economy. Today we're going to give you a crash course in Canadian taxes. Now, I've been a Canadian for more than 20 years now, 2 decades. Well, happy Canada Day! Yes, I am a Canadian, I'm a very proud Canadian. I've been a Canadian, since age of 14, since I arrived to Canada. I'm still shocked how much we pay in taxes. So Kyle, give us a crash course on this. What is going on?
Yeah, well, essentially the idea with Canadian taxes is that we want to lower our tax bill as much as possible.
Of course.
And actually there's a lot of things that the government actually gives us to be able to do that. So we can lower our tax bill quite a bit.
Yes.
If we look at the Canadian tax system, it's something we call a graduated tax system.
Okay.
So that means that the lowest income earners pay less tax and the highest income earners pay more tax.
Okay.
So the whole idea is that, at least on paper, what we want to do is reduce our taxable income as much as possible. The other thing is that the Canadian tax system treats different types of income in different ways.
Okay.
So we want to look for the types of income that are going to give us the best tax treatment.
Got it. And what are some of the tax bracket, what are some of the percentage and numbers?
So if we look at the lowest tax bracket, people who earn the lowest amount of money in Canada, they actually pay zero tax. So that goes up to about $13,000. The actual number is $13,220.
That's tax-free?
Yeah.
It's a low income? Yeah.
Exactly.
Okay.
Anything below that will be tax-free. When we get above $220,000,
That's the highest tax bracket?
exactly, we'll have to pay 53.5% tax.
More than half.
Yeah, more than half of
More
what we
than
make
half.
will be gone in tax.
So 200K, half of that goes to the government.
Yeah,
You pay taxes.
more than half. Yeah.
Ooh, all right.
So again, when we look at the way the tax system is set up, what we want to do is we want to bring our income as low as possible, as we can.
So what are some of the things that we could do?
Well, one is what I just mentioned just a moment ago in terms of the different types of income with the different tax
Active
treatment.
and passive?
At this point, what it is, it's looking at salary versus dividends versus capital gains.
Got it. Okay, walk us through all three. If you
Okay, so salary and interest income, there's a lot of income that's fully taxable. So, of course, that's always what we want to avoid where possible. So if we own a business, we probably want to pay ourselves a lower salary and look at deploying that money somewhere else.
Got it. And you think about from the government perspective, the government, from my understanding, is always they want to reward you for kind of leaving the money in the business, create more opportunities, create more value in the economy, and employ more people. That's what the government wants to do. The government, in some way, kind of punishes you for taking the money out personally for personal, consumption.
Yeah, and just to follow up on what you said, exactly.
That's the philosophy.
That's the way it works.
Yes.
The government punishes you for taking the money out. And if you just invest the money passively in your business, they'll punish you for that too. They want you to grow your specific business.
Yes, they want to create jobs, right? That's how they get more taxes. So from that perspective, understand that's what the government is thinking.
Exactly.
And then it gives you a better understanding of why they do certain things and why they have certain policies, right?
Yeah.
Yes.
So when we look at the other tax treatments, there are dividends. And there's either eligible dividends or ineligible dividends. Both are significantly lower than what we would pay in salary, for example.
What's the percentage on that?
The percentage is 48.89 for an ineligible dividend, which is going to be the most common dividends that people take out.
Got it. And then capital gain?
And then capital gain, it's a little bit interesting with a capital gain. We still pay the highest tax rate on a capital gain, so it's still going to be 53.5, but we only pay that 53.5% on half of the gain. So half of the gain is tax-free, half of the gain is taxed at our normal tax rate.
Got it.
But as you were mentioning, with a business, an active business, governments want to reward that, especially small business in Canada.
Correct.
So if we look at the active business rate for a small business in Canada, it's 11%. So when we think of the difference between keeping the money in our company and growing our company as opposed to pulling the money out, it's 11% to keep the money in the company. It's 53.5% to pull it out. Right?
So that's how much the government wants to incentivize business owners to keep the money within the company and not take it out.
Exactly.
They want you to grow the business. They want you to be active. They want you to employ people. So just keep that in mind, because I think this is something that, and of course you can write off a lot of different things within a business.
Yeah.
Why in terms of in Canada, when you are just an employee, it's harder to create wealth, because it doesn't matter what you do. If you're earning high income, you're taxed at the highest bracket. But if your business, you got write-off, you pay less in taxes, now you can have your money working for you more, right?
From a tax perspective, the last thing you want to be in Canada is an employee.
Yeah, from a tax perspective. So everybody should have a business of some sort,
Yes.
ideally.
Exactly.
Ideally, yes. And what are some of the tax incentives that the Canadian government provides us?
Well, number one is the small business deduction
Okay.
that we just talked about.
Yeah.
Also, if you do start a business, say you just start a whole home-based business and you're using your home as your office,
Yes.
you can start to write off things like mortgage expenses or electricity, internet.
Yeah, for your
they may be
Wi-Fi.
small
Yeah.
expenses,
Yes.
but what you can do is you can start identifying things in your life that you're currently spending money on.
For business.
Yeah, exactly.
Yes.
And we can start to use that as a deduction rather than just paying the tax on that money.
And other tax incentives?
Yeah, there's a few other incentives. One is the capital dividend. So we can take a capital dividend out of our business, which is essentially like getting a return of capital from the business. And when we take that money out of the corporation, it's tax-free.
Okay.
So the government is incentivizing things like capital gains investments within your corporation and getting life insurance within the corporation.
Got it. It's like a little loophole.
Yeah, you could call it a loophole.
A little loophole that they
It's
have.
legal though.
Yes. And what about charities?
Well, yeah, so there are a number of ways that we can use charitable donations to help lower our tax rate. A lot of the more wealthy families in Canada will have their own foundations.
Foundations, yeah.
So business can include a lot of good things that you want to do for the world, right? So a lot of these ultra high net worth people will actually create a foundation that does good in the places of the world that they think is the most valuable. So they'll be able to use that foundation to make charitable donations where they're still somewhat in control of the money and where it goes, but they get the charitable donations.
So in some way, the Canadian tax system, as an employee, you make money and then you get taxed and you spend on what's left over. But as a business owner, you earn money, but then you can spend money, a lot of write-offs, and then you pay tax on what's left. That's a big difference, right? That's the advantage of, even if you are a small business, have some kind of tax deductibles. It might not seem a lot, but you can write off like certain percentage of your mortgage, or you have a basement turned into an office, certain equipments that you have, office supplies. It adds up.
Yeah,
It adds up.
especially a cell phone bill.
Yeah,
It can be expensive.
before you know it, like a little recurring here, a little recurring there, it adds up. And when you take that out, a year, 2 years, 3 years, 5 years, that's the money you can use towards to building your wealth, right? Tax is one of the things that I think, one of the things that we spend the most money on that we don't pay attention enough. So that's the little crash course in the Canadian tax systems. If you enjoyed this video, make sure you hit the subscribe button and comment below if you have any questions, and I'll bring Kyle back to talk more about how to save money on taxes as well in future episodes. So see you next time.